Top of the hour. Hello, good afternoon, and thank you for joining our webinar today entitled Leveraging Regulatory Change to Drive Better Customer Service. My name is Gary Cuttress and I'm the Sales Director at SureComp Business Systems. It's our mission to provide innovative trade finance solutions hosted either on the cloud as well as on-premise for corporates and banks around the world. It's my privilege to be your host for today's proceedings, which will explore the SWIFT guarantee message changes and how they can present an opportunity for change, for optimization, and to improve the all-important elements of customer service as digitization of trade finance provides opportunities for organizations globally and no longer restricted to transactions in that particular city or that particular country. We will discuss how to alleviate the burden of the SR 2021 transition, learn how to leverage digital trade finance solutions to future-proof your business, and most notably, how digitization can improve customer service and drive growth without interruption to your business. Before we get started, just a couple of quick housekeeping points I'd like to share. We have attendee registrations from 44 different countries for today's webinar. So to give everyone a chance to hear clearly, everyone is and will remain muted, but I do encourage you to ask any questions via the chat function just below in the Zoom box, and then I'll ask them of the panel when we have time at the end of the session. The session is being recorded and will be made available on demand afterwards for anyone that would like to really look at this or to pass on to their colleagues. So I'd like to start by introducing our impressive international speakers for today's webinar. Anne Catherine Arneson is a career banker and has been with Norway's largest financial services group, DNB, for over 4 decades, has a wealth of experience across the bank. DNB are one of the world's foremost shipping banks and has a global network covering 27 countries. Anne Catherine is DNB's head of international guarantees and perfectly positioned to provide a view from the bank on this topic. She is based in Oslo and I welcome her to the panel. We are also joined by Nikos Karolos. Nikos is head of banking at Profile Software, and SureComp are collaborating with Profile for this webinar as they are one of our key strategic international partners. Profile helps banks address their technology needs in many areas across corporate and transaction banking, wealth and risk management. Based in Greece, Profile works with banks across many parts of the Southern and Central Europe, as well as the UK, the US, the Middle East. So welcome to Nikos. And finally, my colleague from SureComp, Andrew Coles. Andrew is a seasoned trade and supply chain finance expert who recently joined SureComp as the head of global solution consultancy. Andrew's career has been built around trade and supply chain finance and has many years' experience working with banks to help address their business needs with the use of leading edge technology. He has held delivery, solution, consulting and pre-sales roles covering the US, Europe, the Middle East and most recently Asia Pacific. Andrew is now based in London. And it would also, I should thank Trade Finance Global for being our media partners, allowing for today's event to take place. So to get this webinar underway, I'd like to hand over to Nikos, who's going to say a few words about Profile and kick off today's discussion. Nikos?
Thank you, Gary. Thank you all for joining us. Starting off with a few words about Profile Software. Profile Software, we are a leading provider of financial solutions for the last 30 years. We have a presence in 45 countries and offices in 10 major financial centers around the world. Now, with the core banking system as one of the leading platforms in our total financial solutions offering, regulation is apparently an equally important issue for our systems, as it is in the trade finance domain. Therefore, it is really interesting to have the opportunity to discuss on this with SureComp, focusing for today on the latest Swift release 2021 changes. And now giving the floor to Andrew. Andrew, could you please start by outlining the nature of the changes and what the drivers were behind them? And eventually, how will these changes improve trade finance operations going forward?
Thank you, Nikos, and thank you to everyone for joining this webinar today. Our view is that there has been a definite trend in recent years that has seen an increased usage of guarantees to facilitate international trade. Like LCs, guarantees can provide the risk mitigation required to build trust, but without the costs associated with checking documents and managing discrepancies. But despite this, the cost of providing these instruments can be quite high, as there are still many inefficiencies in how guarantees are handled, with large amounts of unstructured text causing delays in processing, sometimes taking days or weeks to turn around a request from the customer. This leads not only to pressures on margins, but more importantly to delays in servicing the customer. Those customers often find themselves in urgent need of a bank guarantee in order to secure a business opportunity or to win a new contract. Although cost is always an important factor, corporate customers will often be choosing their banking partners based on the level of service they can provide, and they are increasingly demanding sophisticated digital solutions that can provide a rapid response and quick decisioning, allowing them to manage their business effectively and be competitive. A lack of standardized structured data is really preventing banks from being able to provide this service. And just on that topic, what we found is that today's customers are increasingly expecting a big tech-like experience in all of their digital interactions. Just like in their daily lives, they want immediate visibility of transactions with the ability to track them as they would a parcel sent through DHL. They want fast turnaround times, same day delivery, as they can get for a premium price from Amazon. They don't want to be dealing with physical documents. They want a fully digitized experience, and they want a platform that provides them with smart suggestions, providing guidance on how best to complete their guarantee application, for example, helping them complete their daily tasks faster and more efficiently. This user experience is playing an ever more important role in shaping customers' choices regarding who they use to provide their banking services. In fact, a recent survey indicated that 70% of corporates are choosing their banking relationships based on the available digital capabilities that can be provided. Now, I'm sure this picture resonates with a lot of the audience, especially the banks. Swift has been rolling out significant changes to their messaging standards over the last few years, perhaps the most significant changes in a generation. The updates in 2018 for letters of credit related messages required banks to invest a great deal of time and effort in updating their back office systems. It's fair to say that some banks were better prepared, and they planned well in advance to those changes, but others less so. This next round of changes, the ones for guarantees and standbys that we're talking about today, were originally scheduled to follow immediately after in 2019. A lot of banks at the time felt it was too soon, and they needed time to prepare. Originally pushed back to 2020, and now again to 2021 due to COVID, for instance. I'm sure that some banks were grateful for the delay, although I believe my co-panelist today has a slightly different view. And these pressures aren't just being applied by Swift. During a recent ICC survey on trade finance, the burden of compliance and the landscape of constantly evolving regulatory requirements was recognized by participating banks as a significant concern. And we don't really see this ending anytime soon. The upcoming rollout of ISO 20022, the transition away from LIBOR, and not to mention the Basel IV regulations around capital liquidity are all adding to these pressures. The ongoing maintenance of the underlying systems of records that is needed to support these changes is far too often regarded as a sunken cost, increasing pressures on the business, eroding margins, and decreasing profitability. Additionally, the risk of non-compliance can be extremely costly to even the largest of institutions. So to your question, Nikos, about how will these changes improve trade finance operations going forward? Well, I strongly believe that with proper preparation and planning, banks can look at these changes as an opportunity and not as a sunken cost, and not just as another regulatory burden that they need to comply with. The upcoming 2021 changes from SWIFT have been squarely aimed at addressing some of the challenges I mentioned earlier. Without going into too many details, we can see that the key benefits lie around a vastly improved data set, as well as new message types to support specific transaction flows. The main change is about replacing those large, unstructured text fields of the MT760 and the MT767 messages with highly detailed and structured information. Naturally, trade finance processing systems such as SureComms use these messaging standards as the foundation for our own data models. Adopting these new structures will allow for greatly improved operational efficiencies across the full end-to-end guarantees workflow and bring with it an increased amount of straightforward processing. For example, as I mentioned earlier, being able to support AML and sanction screening requirements can be extremely burdensome, especially when dealing with guarantees containing large amounts of unstructured text. These new data structures will bring far greater automation to this process, improving turnaround times, whilst at the same time reducing risk. Detailed data structures will allow banks to be able to build more business rules around that data. It will help in defining process improvements, which could in turn support operational changes. The improvement in processing times will most definitely benefit the customer. Providing faster turnaround times will enable them to remain competitive, whilst possibly allowing banks to offer premium services to the customer against agreed SLAs. A large number of available data elements can improve bank-to-customer interactions. Companies submitting their guarantee applications through an online portal, for example, will benefit from greater validation at the time of entry, reducing possible errors and achieving higher levels of straightforward processing, with the data captured at the customer end validated all the way through to the underlying bank-to-bank message. It also provides greater opportunities to harness APIs and interoperability standards, as well as allowing banks to leverage new technologies, such as AI or machine learning, for instance, to perform better risk analysis, predict trends that may affect the customer, or provide smart guidance during the guarantee application process. Moving forward, banks should consider whether the new message standards may enable them to plug directly into their corporate client systems using open APIs. This could enable corporate clients to request and track guarantees from their banks directly from their treasury management solutions as part of their existing procurement workflows. And I was wondering if I could maybe bring you into the conversation. Having recently completed the upgrade of the system to be SR 2021 compliant, which I understand is still in switch-off mode, waiting for the November transition deadline, what benefits do you, as a banker, expect to see as a result of these upgrades?
Well, you already mentioned them, Andrew. So we were very much disappointed about the second postponement because we have been looking so much forward to this implementation. The more structured messages will reduce operational risk and improve quality in our processing, for sure.
And how do you think the new message types that are provided as part of SR 2021 will help you from an operational perspective?
Well, the processing will be easier because we will know what the message is about. You know, the 799 messages, they could contain everything. Now there will be more specific, so we will know in advance what to handle and treat them in the right way.
So, for instance, the demand message, the new demand message.
Demand messages are urgent and they need to be handled right away. And now we have to look through and we can have a big bunch of 799 and in between there could be a demand without us noticing it once.
And how do you feel that this will help your business? Well, not just now, but in the future in terms of customer service, for instance?
Our customers, of course, they will not have the upgrade will not have a direct impact on them because they don't see the SWIFT system, or very, very few of them operate the SWIFT system themselves. but they will benefit from faster turnaround times. And I believe also less misunderstandings and questions back and forth, which are the situation today. We have 799 back and forth many times before issuance. So our customers will perceive quicker deliveries. And also, as you mentioned, they will have digitized processes. They will expect digitized processes. And these structured messages will enable us to automate much more in the future.
So I expect you're hoping to see a reduction in processing time and an improvement in operational efficiency as a result of these swift changes.
Yes,
And
which our customers will benefit from, because as you said, they are expecting faster and faster deliveries. A few years ago, we had 5 days delivery time. Today, customers expect same-day delivery.
5 days the same day. That
Yes.
is wonderful improvements. Wonderful improvements. Nikos, I'm wondering if I could maybe bring you into the conversation a little bit and ask you, in light of not just the swift changes, but the wider regulatory changes that are going on, how can Profile, for instance, support these changes and help banks leverage the benefits?
Thank you, Andrew. Well, it is a fact that there is tremendous activity on the regulation domain, and this affects all aspects of the banking operations, starting from digital banking, onboarding, KYC AML, reaching over to prudential risk management, payments, and operational resilience. Now, the obvious target is for banks to comply within the deadlines that are communicated. But as has been mentioned previously, the driver for our support is that banks should comply in the most cost-efficient manner. So we focus on two axes. First, the technology trends and the product capabilities, and the infrastructure and architecture. Now, apart from, of course, having a team of experts constantly monitoring all the changes so that we are ready in time for our banks. And regarding the product capabilities, technology and automation are the keywords because keeping up with the technology trends will help the bank leverage the latest technologies, so apply the AI and machine learning trends and the capabilities over multiple business domains. It helps them move forward with the digitalization process, which has been accelerated over the last few months, the last period. It allows the adoption of changes only through configuration up to a big extent, and also minimizes operations disruption. Now, if we combine the cost efficiency that results from the technology adoption with high automation and STP features that are available in our products, we provide banks with software that enables them to get the maximum possible benefit from regulatory changes across the operations domain. But at the same time, equally important is that any changes have to be deployed easily and safely. We don't want to risk glitches due to compatibility breaks or even worse, force the banks to perform full release rollouts in our software. Now, apart from system modularity, which is a design feature, cloud infrastructure also seems promising towards this direction. And Andrew, at this point, I would also like your view on this. Yes. How could cloud adoption help to, future-proof and alleviate the IT burden going forward?
And it's a great question, Nikos. And cloud, we can look at it from two perspectives. One is from a cost benefits, and it's well documented that the operational cost benefits that banks or any institution can gain from a cloud migration strategy. Taking the infrastructure costs and having the scalable nature of cloud can really kind of reduce down the IT cost for a bank. But combine that with a managed service offering or a software as a service capability, for instance. And here is where Surecom, we offer, well, all of our solutions as part of a managed service, but specifically if we talk about trade finance as a service, this is provided as part of a full managed service offering where we're not only taking care of the IT operations, but we're also taking care of the upgrades and updates of the solution to meet regulatory changes. One thing we've noticed is that the cost for these regulatory updates is often not budgeted or not foreseen. And that's come as a bit of a shock in some cases. And the total cost of ownership for a solution now has to incorporate the mandated changes that are coming as part of the regulatory change. A fully managed service is part of an annualized subscription fee. You have consistent visibility on what those costs will be to remain compliant, as well as reducing down your own IT burden of supporting multiple systems or even managing legacy systems where the knowledge of those systems now is moving on, is outdated. So there's a lot of benefits from moving to a cloud and managed service perspective in order to see operational benefits, see cost benefits, move from a CapEx model to an OpEx model, but also to ensure that you have a modern digital system that is up to date with the latest regulatory changes and is ready and adaptable to the new technologies that are being developed in the market, such as marketplaces or consortia for trade finance, or whatever the next innovation might be. So I think with that, Gary, I believe we have a few questions that have come in.
We do. Thank you, Andrew, and thanks to the panelists for providing such a good insight into this topic. I think with forced disruption, there comes opportunity for change, and the opportunity to be had from these swift changes is indeed going to be interesting. That's going to prove that. We do have a question in from the audience. And we do have a couple of minutes, so if you would like to ask the speakers something, now is the time to put something into the chat window below. But we do have a question from Mahendra. Mahendra asks, in today's scenario, do you think the physical movement of shipping documents becomes major concern between the parties involved in trade? And further to, how do you mitigate by using the technology? And can we see as a new opportunity to develop new trade platforms to support the trade across internal borders?
Yeah, so if you don't mind, I'll take a first stab at answering that. Today's scenario, in this current world of a global pandemic, the physical nature of documents has been a huge hindrance to trade. In fact, it's been near impossible to actually physically present documents in many places. And this has really accelerated the adoption of digital documents of title and the acceptance of digital documents of title. For me, it's never been a case of can the technology support this? These use cases have proven the technology is there. It's been about the regulatory bodies moving forward and accepting these. And we've seen huge progress in this area in the last week, with G7 nations pledging to accelerate the adoption of digital documents. And so to your question, yes, most definitely. Once the regulatory bodies accept these documents, the digital documents have the same legal standing as physical documents, then new technologies and new platforms can be developed to really leverage this to facilitate both internal trade but also cross-border trade. And it's something that we at Surecom are very excited about.
Good, thank you. So, and Catherine, I just have a quick question for you. What advice would you give to other banks and corporates who are looking to use this change as an opportunity for improved operations and customer service?
Well, we have taken the opportunity to clean up a bit in our templates and processes at the same time, because I don't know about other banks. It might be that they are in better shape than us, but we had a lot of legacy which was added on. So now we have really done a cleanup, which will enable us to be much more efficient in November. So we can't wait for November. But then also don't underestimate the time and resources needed to implement this, because it takes time, and it must be spent the necessary resources to do this in a good way. So if somebody out there thinks they have plenty of time, they haven't.
Yeah, time is the thing. Time is the thing. I suppose, Andrew, a similar question to you. With that timing thought in the back of your mind, if banks start on this journey now, when would they be ready to compete globally in this space and grow their market share by offering that customer service, that improved customer service that this solution may bring?
Well, a very interesting question, and ideally banks should have already started on this. But really, for me, the choice for the bank is: are you ready to harness this opportunity? Any bank that's choosing to do something should choose an approach where they see this as an opportunity for growth, and they should be focusing their investment on a future-proof digital solution. And they need to consider how these digital solutions can help them attract and retain customers to increase their market share. As I said, ideally banks should have started on this now. We're now May, June, and the switch over is November. However, we have had requests from some banks that are struggling, shall we say, with upgrades on their legacy banking platforms. If we can provide a guarantees as a service solution as part of our cloud offering, and the answer to those is, well, yes, but the time is of the essence. It's possible to meet those deadlines, and provided that you're meeting those requirements on a platform, a future-proof platform that's ready to leverage the benefits that these changes can bring, and has the ability to connect into the fintech ecosystem and to connect through APIs, then you're definitely taking advantage of the opportunities at hand.
So yeah, so to paraphrase, time is of the essence. If you need to do something, you need to do it now.
Yes,
indeed. All right. Thank you, everyone. We're just about out of time. Thanks again to Anne-Catherine, to Nikos, to Andrew, and thanks to you for joining this webinar. If you have any questions that you did not have a chance to ask, then please do send them over to marketing@surecomp.com, and we'll relay them to the panel and respond back to you just as soon as we can. We'll also be in touch to share the webinar recording when that becomes available. And all that's left for me to do is thank you again and wish you a great rest of the day. Thanks and goodbye.